All right, hello, and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James. And before we get into today's podcast, just a quick disclaimer: nothing in this podcast should be taken as investing advice. Um, James or I could have positions in any of the stocks you mentioned in this podcast, and we reserve the right to change those positions at any time, with or without notice. So make sure you do your own work and consult with a professional before making any investment decision. With that being said, the topic of today's video is going to be Rivian. So we've talked about Rivian before on this channel, but Rivian recently released their Q2 earnings of this year, and so it's a good time to look back and see if anything has changed versus what we thought about the company previously. But before you get into the Q2 results, just a quick recap of Rivian for those who aren't as caught up on the story. Rivian is a company that we believe has very unfavorable dynamics for a number of reasons. Those being the main ones being unfavorable unit economics of their product, recent apparent demand weakness for their vehicles, and also some concerns we have for their upcoming mass market R2 models. So the first one, the unit economics. It's important to note that Rivian's cars are very, very premium. So the R1 SUV and truck variant are both over $70,000 plus starting price. But despite the very, very premium price point of their cars, the company still loses tens of thousands of dollars on each vehicle they sell. So in the most recent quarter, they lost $33,000 per vehicle that rolled off their lot. These losses pile up, and the company is overall losing about $1.4 billion per quarter in net loss. Compare that to their about $8 billion of cash and equivalents and $5.5 billion of debt. So that $1.4 billion that they're losing per quarter is a huge number. The second point is that demand seems to be faltering in recent quarters. So in contrast to previous quarters and years where it seemed like production was a bottleneck, for the first time in the fourth quarter of last year, delivery volumes started to fall. And we can see this also reflected in the company's starting to try to reduce the selling price of their cars. They recently started offering a cheaper, smaller standard battery pack in order to get the minimum selling price down in order to spur demand. And the final major point is that their upcoming 2026 release plans for their R2, which is basically their smaller version of the R1 and designed to be a cheaper price point mass market vehicle. We believe that there's some problems in their disclosed plans for this vehicle. They have not given very many details about how they are going to be able to mass produce this car at a profitable level, especially considering the fact that the R1, which seems to be very, very similar to what the R2 is going to be, just slightly bigger and with a little bit more bells and whistles. The R1 currently costs over $100,000 per car to produce, and they're currently planning to sell their R2 in 2026 for only $45,000. So how are they going to get the cost to produce the R2 down by over 50% versus the R1? They've not been able to give very compelling plans to show that they'll be able to do that. So those are the three main points why we have thought that Rivian is a poor business model. So I'll kick it over to you, James, to talk about the most recent quarter's earnings release.
Yeah, so before I get into that, just a quick pause to talk about our website, differentiatedanalytics.com. So if you don't already know, we have this website where we publish our premium professional quality short selling research, where we identify companies that we believe to be either fraudulent or overvalued. And we find our highest conviction short ideas and we write detailed research reports about them, which are available to premium subscribers on our website. So if this at all sounds interesting to you, make sure to check out differentiatedanalytics.com. The link is in the description below this video. So with that out of the way, Ryan has done a good job laying the groundwork of the Rivian story. So I'll just dive right into the second quarter results and what this means for the company going forward. So in the second quarter of 2024, Rivian temporarily shut down their production facility in Normal, Illinois, where they did a bunch of upgrades. They shut down the facility so they could do a bunch of upgrades, which they say will put them on a path to profitability eventually. And because of this shutdown, their production, the number of vehicles they produced, decreased massively in the fourth quarter because the plant was shut down for a period of time. But the deliveries were about flat. So they were able to sell off some of the excess inventory that they had built up over the prior quarters. Now let's dig a little bit deeper into their supposed path to profitability. So all the way back in the fourth quarter of 2023, so this here is taken from an investor presentation they gave for the fourth quarter 2023. They explained how they are going to achieve gross profit breakeven by the end of 2024. And they provided this chart showing all the various levers of how they're going to increase their gross profits. And one of them, the first two of them, they say they're going to decrease their fixed and variable costs. And this is related to the temporary shutdown of the factory in Q2 of this year, because that's when they're doing all the upgrades and making various changes to the vehicle and the production lines, which they claim is going to lead to a massive reduction in fixed and variable costs. And then the third part of their plan to break even is they are going to increase the revenue per vehicle sold by 15%. So they said between Q4 2023 and Q4 2024, there's going to be a 15% increase in the revenue per vehicle sold. And to put this into context, in the fourth quarter of 2023, revenue per vehicle sold was $94,000. So according to their guidance of a 15% increase, that would be that their revenue per vehicle sold would have to increase to $108,000 by the fourth quarter of 2024. But if we look at the results over the prior two quarters, the numbers have actually been trending in the opposite direction. And in the second quarter of 2024, the revenue per vehicle sold was only $84,000. So why are the numbers moving in the opposite direction compared to what Rivian previously forecasted? Well, it's not too difficult to understand what's going on. The main thing is, as Ryan talked about earlier, in the first quarter of this year, they launched their standard battery pack, which has a lower price. So that brings down the minimum price that it costs to buy a Rivian vehicle. So that brought down the average selling price. And so in the first half of this year, more people are buying the cheaper version with the standard battery pack, and that is dragging down the average selling price. So why did they launch the standard battery pack? The reason was because, also as Ryan was talking about earlier, by the end of 2023, with interest rates rising, with the EV market saturating a bit, it was becoming clear to Rivian that there was not sufficient demand from consumers to buy all of the cars that they were producing. And this was because the prices that they were charging were too high. These are very premium priced vehicles. So they were not able to sell all of their production. So that's why they were obliged to launch the standard battery pack at a cheaper cost. And, given the dynamics of the weak EV market and the fact that they were basically forced to reduce their prices with the standard battery pack, how is it even possible that they would get up to their target of $108,000 per car by the fourth quarter? So they talked about how they expect to receive some regulatory credits. And they also expect to, make a little bit of revenue from pre-owned vehicle sales. We talked about that in our previous video, which is linked in the description below. But those ancillary revenue streams are pretty minimal, and they're not going to get Rivian up to the $108,000 revenue per car. So the only other thing that could potentially increase their average selling price is they say that at the end of the third quarter, they are going to launch their tri-motor variant of the R1T and R1S. And this tri-motor variant is the ultra premium model, which will have far superior performance characteristics than the other versions. And this tri-motor variant, this premium tri-motor variant, will have a starting price of $100,000, which is way higher than their average selling price currently. So this will help to boost the average selling price. However, I am quite skeptical that this is really going to move the needle, because the fact that they had to even, the fact that the average selling price has been declining over the past couple quarters, this is because the fundamentals in the EV market, the fact that with interest rates going up, it's more expensive to finance your car. And with all of, the large amounts of competition and the oversaturation of EVs in general, this is making it a more competitive market, and people are not willing to pay so much to buy a Rivian. And given that that's the case, I don't think that many people are going to be spending $100,000 to buy this new ultra premium tri-motor variant. So I seriously doubt that this is going to, create this huge boost to average selling prices as Rivian is projecting. So that's my skepticism on the average selling price. Now, the other two aspects of their supposed plan to break even is the variable and fixed costs of production. They claim that with this recent shutdown they did in Q2, they changed everything. They renegotiated contracts with their suppliers. They simplified the production process, et cetera, et cetera. And this is going to lead to massive decreases in production cost. Now, this only happened in the second quarter and basically just got finished up. So we're not going to see the full effect of this until the third quarter. So it'll be very interesting to wait until the third quarter and see what their gross margins are then. But as of now, because basically we don't have enough information yet, because this plant these upgrades only just happened recently. They haven't shown up in the numbers yet, so we can't really judge. So that's just something we're going to have to keep our eye on going forward. Now, one thing that's very important to talk about is, let's just give Rivian the benefit of the doubt and say that by the fourth quarter they indeed achieve gross margin break even. The problem is, even if they achieve gross margin break even, they have operating expenses, so SG&A and research and development expense, that's currently run rating at almost $4 billion per year. So even if they achieve break-even gross profits, they're still going to be losing $4 billion per year, which is a massive loss. And as we can see here, their free cash flow was more than $1 billion in every one of the last 5 quarters. So this company is losing a huge amount of money. And even if they get to break even gross margins, which is far from guaranteed, they're still going to be losing money. And then here's another chart, which also shows how extreme their cash burn situation is. So this here shows their cash equivalents, short-term investments. So basically all of their cash and liquid financial assets each quarter. And it's been steadily declining as they burn negative free cash flow. Now, in the second quarter of 2024, we talked about this in our previous video. In the second quarter of 2024, they issued a $1 billion convertible bond to Volkswagen. So Volkswagen invested $1 billion into Rivian in exchange for this convertible bond, and that was part of the larger kind of strategic relationship between Rivian and Volkswagen. They had burned through that entire $1 billion by the end of the second quarter. So their cash balance was actually flat, despite the fact that they raised $1 billion. So this just goes to show how extreme the losses are and how extreme the cash burn is. And they only have $8 billion in the bank currently. In the most recent quarter, they burned $1 billion in negative free cash flow, but this also included, they also had a decrease in inventory, which slightly benefited their free cash flow number. So had it not been for that, the free cash flow would have been even worse. But so on a normalized basis, this company would be burning more than $1 billion a quarter of free cash flow. And given that they only have, $8 billion sounds like a lot of money, and in absolute terms it is. But when you're burning $1 billion a quarter, that's only 2 years of cash burn. So it's a very desperate situation for Rivian. I think their path to gross margin break even is highly questionable. And even if they do achieve that gross margin break even, they will still be losing a lot of money. So that wraps it up for everything we had to talk about Rivian today. As always, if you have any thoughts or opinions about Rivian, please let us know in the comments section below. And we will see you all on next week's video.